Hi, everybody. It's Peter Schiff. This is Friday, June 17th, 2011. Well, the big news of the day, of the week, is coming out of the Eurozone. Germany now basically acquiescing, crying uncle to the movements in the market and the political pressure, caving in and saying that they are willing now to entertain a solution for the Greek problem that does not mandate that Greek creditors bear the lion's share of the loss. In other words, the people who willingly loaned money to the Greek government, which was obviously overly indebted at the time, they should not have to bear the losses, that instead the losses should be borne by people who had nothing to do with the transaction. They should be borne by European taxpayers, in particular those living in Germany. In fact, they should be borne by holders of euro currency in any bond form collectively. Now, this is a politically expedient solution, which is placating the markets, but it is long-term negative for both the Eurozone and the euro. But, European politicians are no better than American politicians. They don't care if doing the wrong thing means, if doing the wrong thing is politically popular, they're going to do it. Doing the right thing means some short-term pain, but they want no part of that because they want to get reelected. They don't want pain for anybody, and so they want a panacea even if they're undermining the euro. And that's what they're doing because this is a moral hazard. This means more bailouts. If Europe would simply allow Greece to restructure on its own and allow the losses to fall principally on the bondholders, that would be good for Europe. It would be good for the Eurozone. It would be good for the Greeks. It would be good for the Greek economy. It would be good in general because now lenders would be worried about default. They wouldn't loan too much money to governments, and so governments couldn't obligate their citizens to pay it back. They couldn't get that big. They'd have to cut spending. All that would be a positive thing. Now, the euro, of course, rose sharply today. It got back much of what it lost on the week, given this, because it means that there's going to be bailouts, that we're not going to have to take any of the short-term pain associated with doing the right thing. And so the euro is rallying. But what does it mean, for the euro versus the dollar now? Now, I think this means that the euro is going to rise against the dollar, and here's why. Europe, or the euro, is now like the dollar in that nobody is really going to worry about default when it comes to European bonds. They're going to worry about purchasing power. They're going to worry about inflation because sovereigns aren't going to default. What's going to happen is if they get into trouble, there'll be a bailout, and the bailout, of course, ends up being financed by the central bank, which provides the money to fund the bailouts, thereby debasing the euro. So it's now the risk is not one of default, but of inflation. Well, that describes the United States. I mean, nobody really believes that the U.S. government is going to default on its bonds. After all, it's got a printing press, so why default? Printing is a lot easier. So now Europe is no better than the U.S. From that perspective. But where they are better than the U.S. is the likelihood in the near term of cranking up that printing press. You see, our problems in America are much greater. So if you wanted to look at which country, or in the Eurozone group of nations, although they share a common currency, is the ECB or the Fed more likely to flood the market with currency to monetize debt. And hands down, the winner, or in this case, the loser, is the Fed. So between the euro and the dollar loses. Now, the euro is going to have a lot of long-term problems as a result of the moral hazard that the Europeans are putting into place. Now, they're going to do their best to mitigate it. I know they talked about some voluntary losses for the creditors, so maybe there'll be some arm twisting there, and maybe they'll take a little bit of a haircut. But still, I don't believe long-term they can undo this damage that they are creating. But I think the European chickens are going to come home to roost far off into the future, whereas the American chickens are coming home to roost pretty much any day now. And so we're the one that's in trouble. Although it's interesting, if you look at the action with the yen gained on the week against both the dollar and the euro, which kind of means in a three-way beauty contest between the three major fiat currencies, the dollar, the euro, and the yen is the least ugly. And we'll see what develops with the yen in the coming weeks. But this whole idea about default, again, all the talk about the debt ceiling, about how terrible it would be if we defaulted. First of all, no one thinks we're going to default, but we've done it before. We did default in a major, major way back in 1971 when Nixon took us off the gold standard. That was a default. There's no other way to describe it. we had promised our creditors that they could get gold for their Federal Reserve notes. Federal Reserve notes were notes to be paid gold. That's what they were. And of course, we devalued twice, right? Nixon devalued twice, which was in a way a restructuring, where we told our creditors that they weren't going to get as much gold as we promised. But then in 1971, we told their creditors they wouldn't get any gold. That was a complete 100% default. So we've done it. I mean, what do we promise? What does the Federal Reserve promise today? I mean, nothing. If you've got 10 Federal Reserve notes, you're not going to get any gold if you take your notes to the Federal Reserve window. What are you going to get for a 10? Maybe 2 5s, maybe 10 singles. That's it. You're not going to get anything real. So we did default. The fact of the matter is we have a printing press, so we don't have to default. But the result is the same. In fact, it could be worse. We just pay people in money that buys less. So in a way, that's a default. That's what Europe is now doing. Europe is saying, we're not going to default. We're just going to print. And you know, the people who bought those Greek government bonds, they knew what they were doing. They knew they were buying Greek bonds, not German bonds. They were paid higher yield for taking the higher risk. But now they want it to be heads they win, tails, you know, everybody else loses. And we are putting, Europe then has put that moral hazard into play instead of allowing the market to correct and allow the bitter tasting medicine to be swallowed. That would have been very Euro positive and European Union positive. Instead, they took the easy way out. But of course, the markets like that. Anyway, I also want to talk about Bill Gross today. You know, Bill Gross put out a tweet. And, you know, it's not a picture of Bill Gross in his underpants, although it is something equally as scary. And it is Bill Gross's forecast for the way the Fed will unofficially announce QE3. You know, I've been saying for a long time that I don't believe for a second that the Fed plans on exiting QE. I'm just thinking they're waiting for an excuse because they know that if they pull out of the bond market, interest rates are going to surge and this whole phony economy that they erected is going to come toppling down all around them. So I know they're not going to pull the rug out from under this economy, even though that's the thing that they should do. So they're looking for an excuse. Here's what Bill Gross says they're going to do. What they're going to do, according to Bill Gross, and maybe they're going to announce this next week, is the Fed is going to target interest rates for longer-term treasuries. I don't know if it's going to be a 3-year maturity or something longer, but the Fed is going to say, we are going to make sure that rates do not rise above a certain level, and we will buy as many treasuries as we have to maintain that rate ceiling. Now, they might not be calling that QE3, but QE by any other name stinks just as bad. And that's what this is. Think about, what was QE2? QE2 is when the Federal Reserve said, we are going to buy $600 billion worth of treasuries. We're going to print money and buy $600 billion worth of treasuries over a period of time in order to make rates lower than they otherwise would have been. Now, they didn't target a specific rate. They just said how many treasuries they were going to buy in order to bring rates down. Now, what do they say? According to Bill Gross, now what they're going to do is say, look, we're not going to give you a number. We're just going to buy as many bonds as we have to keep a specific level of interest rates. Well, it's a distinction without a difference. In fact, it's actually more quantitative easing than QE2 because it's an unlimited commitment. Who knows how many treasuries the Fed is going to have to buy to keep interest rates artificially low? Maybe $1 trillion. And the thing is, if they're buying all those treasuries, what's going to happen to interest rates on the securities they're not buying? Well, they're going to go sky high because of all the inflation the Fed creates to maintain low treasury yields. So now the Fed's going to have to start buying more than just treasuries. It's going to have to be buying everything. So this is big news. We'll see if Bill Gross is right. But as I've been saying, you know, there is no way the Fed is going to stop printing money, because if the Fed stops printing money, the government has to stop spending it. Now that's much more preferable. But what's more likely, right? That the federal government stops spending or that the Federal Reserve stops printing? You know, I know what I want, but I'm not going to hold my breath. And as far as where I'm going to bet, where I'm going to place my money, I'm placing my money on QE4, QE5, QE6. Now, the Fed doesn't want to put that label on it because it got a lot of flack for QE2, but it's going to do it just the same. It doesn't matter. As I said, it doesn't matter what they call it. You know, it's monetizing debt. It's printing money to buy bonds to keep interest rates artificially low. That's what QE1 was all about. That's what QE2 is all about. And that's what QE whatever is going to be all about, regardless of what the Fed wants to call it. One last comment. I want to talk about the rating agencies because I guess Congress came out today, or somebody, the Justice Department, that they're thinking about prosecuting for fraud. I don't know if it was civil or criminal, the rating agencies for their culpability in the mortgage fiasco, where a lot of the bonds that they had rated investment grade or AAA collapsed, precipitating the financial crisis. Now, there's no doubt in my mind that they're culpable. I mean, first of all, though, the government is very much involved in this process because the SEC sanctions the nationally recognized companies that can rate. And up until 2003, there were only 3 companies that could do it. I think it was S&P, Moody's, and Fitch. Now there's 10. But still, the SEC has to give you permission. So it's a very cozy relationship. But of course, if you go back, look at my mortgage bankers speech that's on YouTube, at Mortgage Bankers from 2006, in which I said that these rating agencies were putting investment grades on junk bonds. I said that the investment rating agencies were rating AAA bonds that I thought were F and that were going to go to 0. Now, I didn't have any of the information that the rating agencies had. I was just an observer. I'm up there in the bleachers, right? Just intuitively looking at the housing market, looking at the capital of a lot of these lenders, and just putting 2 and 2 together, and just knowing that they've got to fail, knowing that these ratings can't be real from where I was. Now, the rating agencies, they had box seats. They were on the 50-yard line down on the field. They had all the information. How could they not have known? They had to know. But the question is, will there actually be any prosecutions? Because I've said for a long time, I think there's a quid pro quo going on here, where the government looks the other way at the mistakes that the rating agencies are making, and the rating agencies looks the other way at what the government is doing wrong and keeps a AAA rating on their bonds. And I'm telling you, AAA on treasuries is just as believable as AAA on subprime mortgages, right? None of it is real. It's all an illusion, and we'll see if anything happens in this respect, because I'm very interested to find out what might happen. Anyway, that's it for this week. Hey, have a happy Father's Day to all you fathers out there, and I will be blogging again soon. Take care, everybody. Bye for now.